Hey friends, I have a dividend stock portfolio that is yielding 3.73% overall. It's yielding a bit lower because I'm optimizing, historically speaking, for dividend growth. But in my recent portfolio update, I shared with all of you how I have aspirations to increase the portfolio-wide yield. I want to get it more to around 4.5%. And I also want to increase my portfolio dividend growth rate as well. I believe both are possible at the same time. I've shared a number of videos on this. I'll link to some of them in the pinned comment below for those of you who have not seen the historical videos on this topic. So, I was traveling for work this week, and while I was on the airplane, I was working, but also I was researching. I was researching a brand new dividend ETF. This one has ticker DIVO. I want to review DIVO or DIVO in the video today because at first glance, this ETF seems like it could help me towards my goals because it has a starting distribution yield of about 4.5%. It's spoken of in high regard in the dividend stock investing community. And so it piqued my interest. I wanted to look into this one a bit more because I'm always searching for that next thing. I'm always searching for how can I improve my portfolio? How can I get that portfolio to the next level? Now, in that regard, I actually made some pretty substantial trades. I made one yesterday, and I made two more today. I'm going to share those trades on my Patreon this week, and I'll link to that in the pinned comment below. But I'm going to follow up next week with a video here on YouTube as well, because these trades are pretty massive, and the trades are basically increasing my dividend income and portfolio-wide yield pretty substantially while also working on that goal of higher dividend growth as well. Some of you may be able to guess the trades that I made already, especially my patrons. They're going to guess that already. But I want to jump into DIVO. I want to share some statistics on the screen in front right now. Check it out. So DIVO, can't even remember the name of this thing because it's so long. It is the Amplify CWP Enhanced Dividend Income ETF. Boy, that's a long name. But basically what this ETF is it's a dividend stock ETF. It holds high quality dividend companies, some of which I own, some of which I do not. I will get to that in a minute. But also on some of the holdings, on a subset of the holdings, it writes covered calls. Some of you may remember, it's been a while, but I tested out this idea of owning a covered call ETF. And I used to own XYLD. I ended up selling it. I still, in my mind, have an interest in adding covered call income to my portfolio. And ideally, I could receive covered call income without actually having to write the covered calls myself. So DIVO, I really like it. Especially why I like it is when I look at the stock chart, it has appreciated over time. And so this one doesn't pay the monumental, huge dividend yields that a lot of covered call ETFs like XYLD will offer, but also it offers capital appreciation. A lot of the covered call ETFs, they actually will exhibit periods of capital erosion over time, and that scares me. That's one of the things that scares me about some of the covered call ETFs. But I like this one because, again, it has gained in value over time. So it's about covered calls. But check it out on the screen in front of you right now. Just some high-level statistics on this ETF or exchange-traded fund is it is just a little bit off of the 52-week high at this time. And so it's doing really well. And you'll see why it's doing well in a minute because I'm going to go over the holdings. This ETF provides a approximately 4.45% dividend yield, or I should say distribution yield, because that yield includes income from dividends. It also includes income from the covered calls that they write. One of the things that's unique about this fund is they actually write the covered calls against positions that they own in the portfolio, and it's an actively managed fund. And so it has a portfolio manager who is writing these covered calls and who is assessing the holdings in the portfolio. The market cap is only 3.24 billion, or the net assets, so it's a smaller ETF. Maybe that's a con, but it's still big enough. It's 3 billion. That's pretty good. It was incepted in 2016. It has 36 holdings, which I'm going to talk about in a minute. It has an expense ratio that's a little higher at 0.56%. but that's because they are actively managing the portfolio. It is a turnover of 66% according to Yahoo Finance. By comparison, an ETF that I own, that I'm building quite aggressively and plan to throughout the rest of this year, is SCHD, and it's only offering a turnover of about 30%. Lower turnover ratios in general are better. This is one of the reasons that I have selected in my own portfolio of dividend stocks to buy and hold forever and to own individual companies. By owning individual companies, I can keep my turnover ratio really low. Turnover is a measure of how often stocks in the portfolio are changing. Stocks are being sold, new ones are being bought. Now the turnover ratio though for DIVO, I wonder if that also includes calls that they're writing. And so maybe the turnover ratio appears a little higher than it really is because they're writing covered calls, stocks are getting called away, they're participating in covered calls. Maybe even the call itself is considered a position, and if it expires without the underlying position getting called away, maybe that's considered turnover. I don't know. Put in the comments below if you own DIVO and you're more familiar with the turnover ratio on that. But that's one thing just off the bat that I didn't like as much, because if I did buy this, I would plan to own it in a taxable account, and higher turnover ratios generally mean higher tax consequences for the investor. And so I want to go into the dividend growth. This is actually something that I looked at right away because I was like, okay, this looks good just at first glance. It's writing the covered calls, it's offering capital appreciation, it's growing over time. It has some cool holdings as well, which I'm going to go to in a minute. In fact, the overlap with my existing portfolio, it's really similar to SCHD. It only overlaps by about 30%. So I liked that. That piqued my interest because I was like, okay, I can buy this and instantly diversify my portfolio. It actually has some holdings like Apple and Visa, which I don't own and I would like to own. So owning it through this would be awesome. But we'll get to that in a minute. But anyway, I'm like, okay, this thing offers almost 4.5% yield. Perfect, right in the sweet spot where I need my portfolio overall to be, given where I am, given my financial needs right now. I'm already using some of my dividends to help pay bills. I want to raise the portfolio aggregate yield. But I was thinking, okay, at 4.5% yield, it should get over time a pretty healthy amount of dividend growth. I would expect, just before I started my analysis, they're probably growing the dividend on average by say 4, maybe 5% per year. I think that would be reasonable with a 4.5% starting yield for something of this nature. But what I found in my analysis was surprising. So, as you can see on the screen in front of you right now, check out my analysis. And so I did a distribution history, and what I'm looking at, one of the things I like about this ETF is they pay monthly dividends, which is great for someone like me. I would use the monthly dividends to help pay bills from this if I added it to the portfolio. I look at the last 12 months, and I sum them up, and the dividends are 1.77671. And so against the current price per share, I'm getting a yield about 4.4%. What I did next is I wanted to look, okay, what's the 5-year compound annual growth rate on the distributions? I should say distributions because these distributions comprise qualified dividends and income that comes in from writing the covered calls. And so I looked, well, what was it 5 years ago? And so you can see kind of in the second set of columns there, I have 8/1/18 through 7/1/19. That's the comparable 5-year prior period to the last 12 months. I sum it up, I get 1.54172. And so I run my little formula on that, and I get a 5-year compound annual growth rate of only 2.88%. So for something that's yielding 4.4, 4.45% to start with, if it's only growing the dividend in the 2s, that doesn't seem right to me. So I wanted to dig further and see if this was just an anomaly. Is something weird happening? What's going on? And so I started looking at some different time periods. As you can see on the screen in front of you right now, I have more columns. So if you look at the third set of columns over, I just want to look, well, what was it if I look at the last year? And so the comparable last year, 7/29/22 through 6/30/23, if I look at that and I sum it up, I get 1.69263. Now, that's the year prior to the last 12 months. So if I compare those two time periods, I get a 1-year compound annual growth rate of 4.97%. This makes me feel a lot better that if I bought this, I would be getting something that has a 4.5% starting yield, and they're growing the dividend in the 4s, if not close to the 5s per each year on average. But that's only 1 year of data, so I wanted to look a little deeper. And as you can see on the screen again, look at that last set of columns. And so now I'm doing like a 2-year compound annual growth rate. And I want to see, well, how did it do over the last 2 years? If I look at the distributions from 7/30/21 through 6/30/22, which again is kind of the 2-year period prior to the last 12 months, I sum them up. I get all those monthly distributions. There's 12 of them in total of 1.77127. Wait a minute, that looks awfully similar to what the last 12 months offered. And so the 2-year compound annual growth rate is really low. It's 0.15%, and that's probably what's holding back the 5-year. And just for reference, at the bottom of this chart, you can see my portfolio. I have a yield of 3.73%, but my 5-year compound annual growth rate is 4.82, weighted by dividend contribution percentage. It's slightly different weighted by value, but in the same ballpark. And I'm trying to improve that because instinctively I think I can do better, and I proved that through a recent analysis that I'll link to in the pinned comment below. Here's what I'm finding so far with DIVO and what may be a deal breaker for me at this time. And look, I'm not looking to add this overnight anyways. I need to build up SCHD first to a top 5 core position. So until I achieve that goal, I don't plan on adding new positions, but I'm always out there searching, looking for new positions. I want to get my analysis done. I want to present videos like this because I want to know feedback from the community. Put in the comments below what you think about this, and if your analysis shows you something different. If you're seeing something different when you look at this particular ETF. But what concerns me is that the starting yield is good, but where it is, the dividend or the distribution should be growing more. Now, options are volatile. Options premiums are volatile. Maybe that 5-year compound annual growth rate and the 2-year being held down because they got some good volatility at some point in time 2 years ago that is just skewing things. And if we take that outlier out, maybe we could expect that this thing would do similar to what it has experienced over the last year, which is closer to a 5% growth rate. Put in the comments below what you think. It's hard to analyze something like this because it does have a component of dividends and dividend growth, and it has a component of writing covered calls. And again, those options premiums, they could be all over the place. I haven't written this off my watch list. In fact, it's a solid contender on the watch list, but the analysis I've done so far shows me, boy, Ian, focus on what you're doing with your strategy right now, because I already shared a blended strategy. I'll link to it in the pinned comment where I blend a high yielder and I blend that with SCHD, and I'm able to basically add higher yield to my portfolio while also simultaneously increasing portfolio-wide growth. But anyway, I haven't written it off. But I want to share with all of you the holdings that this ETF has as of now. And they can change because it has a turnover of 66% or so. But check it out on the screen. Let's look at some of these holdings. And so what I do with any ETF when I'm analyzing it, because I primarily own individual dividend stocks, is I want to make sure, what does it look like from an overlap standpoint? Because I'm trying here to add something, if I do add it, something that doesn't have a lot of overlap. And so you can see there, I sort this and I highlight it by stuff that I already own. I already own Caterpillar. I already own Home Depot, Procter & Gamble, Honeywell, Walmart, IBM, Chevron, McDonald's, and Duke. So all the ones at the top. If I sum up the weightings on those, it sums up to 32.47%. So just around 30%, kind of like SCHD, overlaps with the portfolio. I like that because it's not too much overlap. And when I start looking lower on these holdings, I'm liking what I'm seeing. It has this Invesco government and agency portfolio, 8.52%. It has United Health, Microsoft, Goldman Sachs, Amgen, Visa, so on and so forth. I highlight Apple here because that's when I sold that I do want to buy back at some point. I can't rationalize buying it right now at the PEs in the 30s, but if those PEs ever get back down into the 20s, I would be a buyer of Apple. I'd like to add that one back because I'm painfully low on tech exposure. I like that it has Visa as well. I really want to point that out. And so having some of that tech exposure in there and growth exposure is nice. What's even more nice and what I love about this is it's hard for me to rationalize, putting the PE ratios aside, buying Apple and Visa because the starting yields are so low. But where I am in my 40s, I'm already using dividends. I need higher yields right now because I'm literally using the cash flow. Buying it so low, I'm going to do it probably at some point. I'm going to put a little money back into Apple, but it's more investing probably for my kids than for me and my wife. It's going to benefit them more just because it takes so many years to get meaningful yield on cost on something like that. But probably the thing I love the most about this ETF is it's gonna, if I buy it, give me exposure to companies like Apple and Visa, but do it in a way where I still get an aggregate 4.45 or so yield on the overall pie. And the way it does that is it's mixing some of these higher growth, lower yielder dividend stocks with a few higher yielders in there, but it's also using the covered call strategy, which I love. The covered call strategy is turning this into a system that can give me exposure to a company like Apple, but do it at the higher yield that I need. And in fact, I like that so much that it kind of, for me, overtakes my concern on CAGR. It overtakes my concern on the growth of the dividend because, boy, to get exposure to some of the companies that this owns at such a high starting yield because of the covered calls and the portfolio mix, that is pretty awesome. I like that. I like that a lot. And so on the next slide, as you can see in front of you right now, I just want to summarize some of my findings with DIVO. And so check it out. And what you'll see here, I have what I like, what I don't like. What I like is that starting yield of 4.45%. It's higher than the portfolio average, and it's right around where I want the average to be. So buying something like this automatically raises the portfolio average, and it's kind of on target where I want to be. It has a covered call strategy, which I don't at this time employ on my own, and I want exposure to covered calls. And I want to do it in a way that doesn't have an erosion of capital, which many covered call ETFs have. As I had just mentioned, it offers lower yielding stocks that I want exposure to that I don't own, but it does it in a way where in aggregate, I'm getting a great yield, which is important for me where I am. There's only about a 30% overlap with the portfolio that's similar to SCHD. I love the monthly distributions. Now, what don't I like? I don't like that really low CAGR overall. Does anyone out there in the community know why is it so low? Could you please point that out in the comments if you know. I don't like the high turnover either, but maybe that high turnover is kind of amplified by the fact, and this is an Amplify CWP fund, but is it amplified by the fact that they're doing covered calls? Put in the comments below if you understand more about that than I do. I'm also concerned about the possible tax implications of owning this in a non-retirement account because that's where I would hold it. And covered calls and high turnover are challenging in a non-retirement account. So that's something for me to keep in mind. Now, would I buy this particular ETF? I would say right now, as far as the universe of covered call ETFs go, this is towards the top of my list, if not at the top, because I like how it's not eroding capital. In fact, it's growing capital over time. Yeah, it's solid on my watch list, but I'm the kind of investor that has to take one milestone at a time. I reached a few milestones in the portfolio just with the trades I made in the last 2 days. I'm going to share them on Patreon this weekend, and I'm going to share them here on YouTube next week, probably end of next week. So stay tuned for all of that. But one milestone that's still left, that's going to take a while, probably till the very last minute of this year, 2024, is to get SCHD up there in the top 5 or really close to it. And until I do that, I'm just going to focus on that because I like SCHD better than DIVO. I do, but I could see myself adding this. Now, I've mentioned Patreon a few times in the video today, and so if you want to join Patreon, check out the pinned comment. But what I want to point out is this book, Pour Your Heart Into It by Howard Schultz. This book, honestly, is one of the best books I have read in a long time. It is a fabulous, fabulous book. And over on Corner Patreon, I have Zoom meetups from time to time, and we're going to have a Zoom meetup next week, and we're going to have a little book club to discuss this book. If you haven't RSVP'd to the meetup so far, please do. Everyone's welcome. And even if you haven't read the book, if you're on Corner Patreon, you're welcome to join. And we'll talk about the book and just dividend stocks and meet and greet, all that fun stuff. And so, but even if you're not on my Patreon, I just want to point out, this is a really solid read. It gives me a lot more respect even than I already had for Starbucks, which is probably my favorite company of all time. And so many people have counted them out, but just wait and see. There are so many good days ahead for Starbucks. And I know, at least in my humble opinion, where they're going, it is going to be exceptional, in my opinion, over the next decade. And so, by the way, if you ever see me out and about, I was at the airport yesterday and a subscriber pulled me aside and said, "Hey, Ian, it really made my day." I share the story about that over on my Instagram, which I also link to in the pinned comment. Connect with me on Instagram. It's a great way to connect with me because on Instagram, oftentimes I do respond to DMs. That's one platform where I feel it's easy to converse one-on-one with members of the community. And so if you want to just say hi, if you want to, if maybe you live in Idaho and you want to talk to me about a meetup here because I'm planning one, or you just want to say hi, connect with me on Instagram. It's a great place. And so I'll link to that in the pinned comment below. And I share the story there from yesterday, how we ran into each other at the airport, and what a great, great occasion. Before I leave today, I want to give a full disclosure. I own the stocks, many of them that I mentioned today. I'm long the ETF SCHD. I am long Starbucks SBUX. I am also long Caterpillar, ticker CAT, the Home Depot, ticker HD. I am long Procter & Gamble, PG, Honeywell, HON. I'm also long Walmart, WMT. I am long International Business Machines, IBM. I am also long Chevron, CVX, McDonald's, MCD, and Duke Energy, DUK. Long list today because I did that overlap analysis with my portfolio. In terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. I'm just sharing my journey for fun and entertainment. It's possible to lose money in the stock market. As always, I have additional disclaimers, disclosures in the description of each of my videos, so check those out. Thank you for watching the video today. I love you all. I can't wait to see you in the comments below. I can't wait to learn the insights from this community about DIVO, because I bet a lot of you know more about it than I do. Share what you think about this ETF, and also share your favorite ETFs in the comments below. And I will see you all in the next dividend stock investing video.